Have you ever sold a stock and thought to yourself, wow, I am really good at this investing thing? Well, I hate to break it to you, but chances are you're not as good as you think. Sorry. There's a very interesting recent study which shows that many investors, like yourself, become overconfident about their trading abilities because they overestimate their trading performance. Here's how it happens. Most investors love to sell a stock when it's gone up because, hey, who doesn't love locking in a win, right? Now, what happens when a stock goes down? Well, in that case, many investors actually hold on, hoping that the stock will bounce back someday. Now, this is a very well documented behavioral trait that we tend to exhibit. It's called the disposition effect, selling winners too early but holding on to losers for a long period of time. Now, the result is that when these investors look back at their trades, they see lots of positive realized gains, but very few realized losses. So naturally, they think, hey, I win most of the time. I must be really good at this. Which is wrong, of course, because they're only looking at their realized returns, not their total returns, including the losses they're still holding on to. And what tends to make matters worse is that our memories aren't neutral either. We tend to remember our wins more vividly than our failures. And so over time, our biased learning from realized gains combined with our biased memory of those gains creates this feedback loop, convincing investors that they're more skilled than they really are. In this particular study, the researchers looked at real trading data from Dutch investors and found exactly this. People who had realized more gains than losses believed that they were better investors, even when their actual overall returns were the same, or sometimes worse. And in a separate experiment, when participants were randomly assigned to experience more winning trades, the study found that these participants' confidence shot up again, even though their overall performance hadn't really changed at all. The main lesson here is that overconfidence doesn't just come from ego, it also comes from bad learning and a biased memory. If you only count and recall your wins, you'll think you're a genius. But in reality, you are just becoming overconfident, which can cause you to trade more, take more risk, and often earn less. So be smart, look at the whole picture, your realized and unrealized gains and losses before deciding how good you really are.